Well, Bob Parker is a senior advisor at Credit Suisse. He is live for us now at the London Stock Exchange. Bob, can I ask you, what is the atmosphere like there? Is there a lot of anxiety out there regarding the Greek debt crisis?
The answer is yes, but I would say that anxiety was evident in markets 1 month ago, 2 months ago, but I would actually say it is getting worse because, first of all, yesterday at the ECB press conference, there was no evidence of support from the ECB for European government bond markets. I do think that over the next week they will probably come in and do a European version of quantitative easing and be a buyer of European bonds. But I think the major concern is that markets are now discounting a high probability of a restructuring led by the EU and the IMF of Greek government debt. And investors are assuming that they're going to have to either accept longer maturities, lower coupons, or some form of discount on their holdings of Greek government debt. So that is dominating. And also, obviously, markets are highly concerned about the contagion effect and particularly focusing on CDS spreads for Spain.
Let's talk a little bit more about the contagion effect. Has there been anything actually that's come out that has quelled the fears for Spain and Portugal? The Spanish Prime Minister's comments not really making much impact on the market.
Well, the clear answer to your question is no, there has been nothing to calm market fears. And you see that in the movement of CDS. You see that, obviously, in the movement of 10-year spreads between Spanish government bonds and bunds. And obviously, one feature of government bond markets worldwide at the moment is this flight to quality. And, with 10-year bund yields now coming down to close to 2.8%, if you ask the question, is that yield level justified? It is only justified by this fear factor in the market with this investor selling of the peripheral European bond markets and switching into the German bond market.
Now, you talk about the flight to quality. There was an idea that perhaps Britain was becoming something of a safe haven with woes about the euro. Is that likely to dissipate now that we look like we're heading into a hung parliament?
I think the answer to that question is yes, but possibly not yet. And the reason why I say not yet is that as at now, we obviously have uncertainty on who will form the next government in the UK. Will it be a minority Conservative administration? Will it be a Liberal Labour coalition? My central case is it's probably going to be, but after many days of negotiation, a Conservative minority government. Markets don't like that uncertainty, and therefore there is no reason to buy sterling or the gilt market. And more importantly is whatever form the new government takes, what will they do to address that budget deficit? And obviously in the campaign there has been from all the politicians, as correctly pointed out by the Institute of Fiscal Studies, inadequate commentary from the politicians on how to address the 11% plus budget deficit.
Indeed, and is that, do you think, going to be the outweighing factor in any negotiations regarding a new government? We need to have a credible plan for the deficit.
Well, if the Liberals are to play a role in either supporting the Conservatives or forming a coalition, I think one thing that could upset markets is that the budget deficit discussions actually could be the second topic. That's to say, the first topic would be demands by the Liberals to go for some form of proportional representation. So again, I think that focus on PR could be a negative for markets because the markets want a focus on how to address the budget deficit.
Indeed, Bob Parker, thank you very much indeed.